Hello and welcome. This is Mukarram from Bullionite. Thank you for joining me for another video session. Today, I'm going to go over an important topic that comes up either when you're trading yourself or you're investing yourself, or it's a question that gets asked from me quite a bit. What is volatility? And are there different forms of volatility? Okay? And how is it that I can take advantage of volatility? So today's video is mostly about volatility and how do you trade off of volatility, okay? So here's the first thing that I want to go over. Just a basic understanding of what volatility is. And this could be something that you're aware of, right? Volatility simply means that a market is having some kind of price action. And what I mean is that it is going up and down, like the price is moving higher and the price is moving lower, right? That's volatility. If you are a market that's staying just flat, like for a few weeks, or a market that moves very little up and down, that's what we call a sideways moving market, but it's not very volatile, right? So the essence of volatility is that there is major price movements, either going higher or going lower. Does that make sense? Okay. Now, is that the only part of volatility that you should know? No. There's a lot more that you can kind of read into volatility, and you have to understand about volatility, right? Because the amateur traders or amateur investors, what I've always noticed is that they love any kind of volatility, right? Because they see the price moving, and then they think because price is moving, that they can take advantage of that price movement, and therefore they can make money, right? But what they haven't learned is that not all types of volatility are good for your account balance or your value of the money that you're trying to make, because most of the time certain types of volatility can take away a lot of the money from your account, okay? And I'm sure you've been there, I've been there, we've all been there, okay? We've learned from it. So here's what's interesting about today's session. We will kind of dissect what's good volatility and what's bad volatility, okay? Good. There's actually something called good volatility, and there's actually something called bad volatility. Then we'll also go a little deeper and figure out, well, what is good volatility? What are the characteristics of good volatility? And what signs do you look for good volatility? And then we'll do the same thing with bad volatility. What is it? What are the signs that show you about bad volatility and how to kind of stay away from it? Okay, so here's the first thing. If a market decides to be volatile, meaning there is buying and selling in that market and the price starts moving higher and lower, now you know that that's a market that you can pay attention to. It doesn't mean a market that you should start trading and investing and trying to make money. You just know that you have to pay attention to it. Why? Because volatility inherently means that there is an ability for you to make money off of that market, right? Now, what is good volatility? Good volatility is when the price action of a particular asset class or a particular market or a particular stock stays within a certain channel that is normal. It doesn't behave abnormally. Now, let me explain that to you, because some people just stop there, right? And I've been in years before when I've been learning, I've been given that information and just stop there. And then we have to kind of figure out what that means. So here, like I always tell you, Bullionite, we give you actionable steps, right? That you can take and you can go and use that to actually create money. So what does this mean? How do we know when a market has good volatility? What it simply means is that most of the time, that particular price action will not, again, I want to repeat, will not be taking out the previous day's high or the previous day's low. Okay? In other words, when the market starts moving, it'll go higher. Let's say it's an uptrending market, it'll go higher. but then the next day it won't come out and take out the previous day's low and then go back past the previous day's high, because that would be nonsensical. It doesn't make any sense. So you have to have sensible volatility. Now, how long does that go on for? It depends. It depends on the trend. But here's a real world experience. If you get into a market based on good volatility, which is sensible volatility that you see on a daily chart, then it could go on for a few days. Like the market will continue to create new highs and not take out previous day's lows for a few days. Then maybe after 4 or 5 days, it could take out the previous day's low. Does that mean that it is disqualified now and it has become a bad volatility market? No. See, that's the secret. Because a good volatility could go on for a few days, then act a little weird, but then come back and get back to its normal channel again. So you shouldn't be afraid to go back into that market and try to make more money off of it, because for one day it simply took out the previous day's low. Do you get what I'm trying to say? Okay. So again, going back, good volatility simply means you will see a market that is trading within a channel. It will not take out the previous day's highs and the previous day's lows in a consistent manner every day or every other day. It will go on a trend, and then after a while, it may take out the previous day's low, but it doesn't disqualify it as a good volatility trade or a good market trade, right? Okay, and then it'll get back on its trend and keep going higher again within its channel. Now, what is bad volatility? It's the exact opposite of that. Bad volatility is a market that tends to behave in a very erratic, unpredictable manner. And what I mean by that is you get into the trade and the next day it takes out the previous day's low. Let's say if it's a market that you think is going higher, and therefore you think the price is going to go higher, but you get into the trade and the next day it takes out the previous day's low, and then 15-20 minutes later, or even before the end or the close of the day, it's taken out the day's high and it's gone again. And then you go, oh my God, and you know, you tend to put a lot of blame on yourself. You're like, oh, you know, I read this market, I think it's going to do something great, and then you get into it, but then you get stopped out, or you lose a lot of money, and then you just exit out of the trade, but then you get back into it, right? And then suddenly it does the same thing. It takes out the previous day's low again, or the previous 15 minutes low again, which is horrible, horrible. Now, I've seen people, like smart, intelligent people, actually get broken down after weeks of taking trades that are exhibiting bad volatility, without understanding that it's not them, it's not their strategy, it's just because they got into a market that has bad volatility. Does that make sense? So what's the advice when it comes to trading markets that have bad volatility, or what I call nonsensical volatility? Stay away from it. Don't trade that market until it comes back to a place where, I assure you, believe you me, all markets will come back to a place where they will have good volatility, and volatility that has the ability that you can profit from. Okay, so here's another thing that I want you to get from these videos, and I'm going to do some additional videos where I will show you actionable steps, where we will do a deeper analysis. We'll look at the charts, we'll look at certain markets, and kind of show you, pinpoint how good volatility looks like, how bad volatility looks like, okay? So you can take this video and maybe the other video, and you can have a series and put it together and say, oh, that's what Mukarram means by good volatility. Oh, this is a market that if I see this pattern, I can kind of get into this market. Oh, this is what Mukarram means by bad volatility, and because of that, I shouldn't get into this market, right? So we'll do that for you, so don't worry. We'll create more videos, we'll do a deeper analysis. But why do I say that? Because volatility has to exist for you to make money. But you can only make money if you participate in markets that have good volatility, and you stay away from markets that have bad volatility. And therefore, you need to understand how to enter a trade once good volatility has been established, how to stay in that trade while it's going through that period of good volatility, And then finally, how do you exit that trade? In other words, how do you manage the trade? And we'll do a video on that and show you that, okay? Now, when it comes to bad volatility, why do I say you want to completely stay away from it? Why is it that I didn't say, well, find out a way on how to enter it. Find out a way on how to get out of it early. Find out a way on how to manage it. Because there's nothing you can do about it, okay? There's nothing you can do about it. It's always this painful experience that no matter how much you try certain things, you'll keep getting clobbered, and you get clobbered. So, and that's because you're getting into a market through impulse. You're impulsively saying, hey, I want to get into this because it just moved higher. I just want to do this. I just want to do this, right? And then what happens is the more times you do it, you'll end up having more losing trades than trades that make money. Once in a while, you'll make money and you'll be happy and you'll be smiling, but most of the time, you lose money if you get into a market that is showing bad volatility. And what is the net effect of trading markets that have bad volatility? Your account balance will slowly trend lower, and after a while, some people don't even have any money in their account. So this is why there's really no strategy to trading bad volatility. Just stay away from it. Keep trading simple. Stay away from it. Wait till it comes back into a place where it's exhibiting good volatility, and then go in with a higher probability trade where you can make better profits and manage your risk better. Okay. As always, when you're trading, use good risk management techniques using stops. And we've even created some videos, and we'll continue to create videos on how to place stops, an effective way of placing stops. So please refer to that. But until next time, happy and successful trading and investing.
Content is for educational purposes only. This is not investment advice from Bullionite LLC. There is always risk for substantial losses in investing and or trading through any financial instrument with or without this or any other type of advertised product. Past performances are not indicative of future results. Different types of investments involve varying degrees of risk. Specific strategies or education presented by Bullionite LLC and its associates in this video are for educational purposes only.